Thank you so much for joining after lunch. Give you 20 or so minutes of data for dessert really quickly, some of the main themes that we're looking to for the year ahead, and thought to codify some of the main topics into 5 themes for 25. And you will have heard it in terms of operators and investors talking about the Mediterranean and particularly how well that's done. So we thought to contrast that back to the global financial crisis and the PIGS, obviously a very different trajectory overall now. Also, what came up to a great degree in the sessions earlier was lifestyle, luxury hotels. They've been on a marathon personal best in terms of performance, so we'll delve in to take a look there. One of the other stories, potential headwinds, is that ADR has been on a fabulous run of growth. We know that that's not necessarily going to sustain as the same. So what does that mean for the year and if not years ahead? Talk a bit about the hotel replacement rate, a bit of a nod to birth replacement rate, population, and what we're seeing overall. And then we'll leave you with some broader themes to take forward into 2025 as it pertains to events. If we start by looking at the global picture, the good news is demand, rooms sold. We continue to sell more rooms as an industry overall. Slight declines on the global stage in February, March, and September, but overall, we're still selling anywhere from 1% to 3% more rooms than we did for each of the months in the prior year. The good news there, if demand is increasing, that also means that that will provide a base for occupancy. And Tom touched on it earlier in his remarks on the panel, talking about occupancy up 2%, that being really the envy of the world in terms of overall growth as well as absolute occupancy. And I think that figure is even more impressive when you think since January 2020, we've had as many as 350,000 new hotel rooms open. So it's not like we've been selling into a static pool. We've actually had a much larger pool of rooms open up. So if we've got demand on the up, we've got occupancy on the up, that also means the average daily rate has a platform for growth. You can see 4% there overall. Your eye may also be drawn looking at Northern Africa, Sub-Saharan Africa, South America. Inflation does weigh heavily within those figures, so please do discount those percentage growth overall. And then if you look to Asia, excluding mainland China, you can see sizable growth as well, but there's still, as alluded to in some of the remarks on stage in the Shaw Theatre, still in the latter stages of recovery overall, so with a bit more fuel to keep them going. So one of our 5 themes for 25 is the revival of the PIGS. And for those of you working either in broader commercial real estate in the space will much know how maligned those nations were in terms of portrayal in the media. But when it comes to overall hotel performance, here we see occupancies indexed back to 2019. And you can see, with the exception of the UK there, it is the likes of Portugal, Italy, Ireland, Greece, and Spain that are continuing to lead us out. All of those main themes that we talked about, leisure, Americans coming over, really bringing us forward. If we look down the end of that scale to those that would be more the laggards, you think about the DACH region, Central and Eastern Europe, the good news is that actually yesterday's laggards are today's growth. You can see the year over year and the axis just below, and Central and Eastern Europe pushing ahead 4%. Also aided by minimal supply, also by the fact that they're at a slightly later stage of recovery. If we look at that occupancy picture overall there, you can see as we head from west to east, unsurprisingly so, larger gains for occupancy overall as we head to the east. Notable call out also for Budapest, which actually had a supply increase of 4%, but demand, rooms sold, was able to outpace that at 8%. So really commendable to be able to see that level of growth. And touched on it with my remark a moment ago about Central and Eastern Europe being 4% in terms of overall regional growth. Notable here, we touched on Budapest, but also worth mentioning Tbilisi, which had a staggering 12% supply growth. Any market that has that level of supply increase is going to see some impression on occupancies overall. Good news for the Baltics, which we know has been a bit maligned in terms of its perception, proximity to the conflict, anecdotal feedback from hoteliers, but the occupancy side of things is heading in the right direction. Average daily rate, as we've all seen, has been simply phenomenal. And I think this illustrates that perfectly when we look back to 2019 there. And we all know the trajectory that it's been on since 19. But I'd tell you to look at the axis below where you can actually see the year-on-year growth. So think about a Portugal, think about a Greece, Spain, 40 to 50% above where they were in 19 and still growing year on year. We'll look to it a little bit later when we talk about moderating ADR. We'd love for that to be sustainable going forward. We know that's going to start to come down somewhat, but overall, it's been an absolutely brilliant trajectory of growth overall. If you then look at ADRs from key cities and national destinations, you can start to see that north-south, or really that Mediterranean and Northern Europe divide overall, quite evident to see across a number of key cities in terms of the growth that we're seeing. But then if we look at actuals, CEE, certainly a lower price point, key cities like London, Paris, Madrid, and others leading the way in terms of actual ADRs achieved across Europe. Really worth calling out the fantastic growth that we're seeing in the Iberian Peninsula. Spain, as we know, if you looked at the economist's remarks earlier from Berenberg talking about the GDP growth that we're seeing in Spain, that being a correlation for demand, albeit we know that international travel is a huge component in Spain. It's hard to find a market on this list that has less than 10% rate growth. If you do, you're talking about the likes of a Lisbon or a Porto, and that's really solely attributed to supply. All of the other fundamentals are in a strong position there, but again, when you start to inject more supply, will have an impact on occupancy and rate. And talked a bit about bifurcation. Tom mentioned that on stage in his panel. Many others did the same, where luxury is headed in one direction and economy and mid-scale is headed in another. Interesting to see that Spanish actually bucks that trend. You can see all classes gaining relatively even in share overall, and really speaks to the broader strength of that market as a whole. It's not just catering to one segment, it's catering to all. I thought this was a nice one, and this is a brand new slide just created yesterday. This is occupancy on the books as of the end of January, so all the other slides you would have seen would have been around December for Q1. And you can see single-digit gains across the board there overall for all of those key destinations, albeit a slight decline in the Balearics, but we're still pacing ahead in terms of positive occupancy trajectory, that as of the end of January. And it was interesting, an article just came out on the FT a moment ago, for any of you who looked at that, TUI saying that they're seeing a slight deceleration in bookings overall, but good to see that as a picture, there's slight deceleration, but overall occupancy still starting to see positive gains. This being one of my favorite pictures that we have here at CoStar, so all of these photos are taken by our field research team who are out in the market. I have yet to be lucky to stay at this hotel in Madrid, still reaching into the purse strings for that one, but amazing property in the Four Seasons. Yeah, it's absolutely stunning property. But luxury itself, marathon personal best, whether it's couch to 5K or you're running the full 26.2, if you run that distance, you're quite exhausted. But what does it mean for luxury to continue going? These slides here charting simply global luxury supply and global luxury demand. And given the strong fundamentals of trading in luxury, it wouldn't be a surprise that supply has eclipsed demand. So we've actually added more rooms than what we've sold. So if we've done that, simple math takes into effect. Before the pandemic, we were selling, say, 7 out of 10 rooms as luxury hoteliers. Now we're selling closer to 6 out of 10. Not necessarily a good story, but made irrelevant by the fact that if your rate is growing 30%, and many hotels and many destinations for luxury will be well in excess of what we're seeing. This is a broad brushstroke across all luxury. You can see there 30% growth. And if you think about all of the fundamentals, the number of millionaires that are forecasted to be present in the world, or the percentage of lodging spend in the US, 40% that's attributed to households that have an income of $150,000 or greater, all of those demographics and wider macroeconomic factors all bode well when it comes to luxury performance. Here we can see by region the percentage that ADR grew relative to 19. So if you're sat in Asia Pacific, you're almost doubling the rates that we saw. If we're sat in Europe, we're talking about 55% growth. Absolutely phenomenal growth overall, but will lead us to beg the question, if we've just run a personal best in the marathon, can we double down and do it again? Evidence here to say this year-on-year figure is 5% for those of us in Europe, albeit 5% if you're achieving such a high nominal rate, quite a positive footing to be on. But while it's not a more price-sensitive customer like we're seeing at the economy end of the spectrum, we are seeing rates start to normalize. And not a huge cause for concern if you're growing 5% on a rate at that height, but still something to consider overall. Touched on that a few slides ago in terms of the bifurcation in Europe. Here's a clear depiction of that, where you can see luxury really pushing ahead and economy facing more challenge overall. I would like to highlight, though, that economy was the first class to recover relative to 19 during the pandemic. So it's not all doom and gloom. It was very resilient overall, and still lots of elements of strength there to speak to in terms of select service, limited service, and the agility that you can see there. This also a brand new slide just yesterday, which I thought is really nice to call out. So here we can see full year across all classes for 24, which collapse class was driving rate across each stay pattern. It was luxury and upper upscale, and it was on your Mondays, Tuesdays, and Wednesdays. We know that leisure was the first one back, but it's also encouraging to see that business travel, read corporate budgets are also enabling some of that growth. Where was that growth most felt? It was in your April and May. It was in your June, July, and August. You'll see that when we look at the profitability data later on, just how important that summer, Taylor Swift, the Olympics, European Football Championships, and overall. Segued to it a moment ago in terms of average daily rate and the moderation there. Here we can see both 23 and 24 against 19. And while occupancies are yet to fully recover, we know that ADR has been the jet fuel to RevPAR recovery overall. If we look at the composition in Europe for each month relatively, you can see it's dominantly been a composition of average daily rate fueling the overall revenue per available room. Interestingly, what we saw in the fourth quarter, though, is more of a shift, and that is encompassed in our forecast later on, where occupancy is taking a larger share of that overall composition. And where are we going to start to see that from? We'll start to see that from this year onwards, where last year, huge events, as well as still a little bit of that revenge travel, pent-up demand, pent-up spending, still enabling that rate growth. Now we're going to see rates normalize on a continental level, albeit here, this is an aggregate for the cities that you see just below, so it's not a pan-European forecast, it is an aggregate of all of those respective cities. ADR around 1% and occupancy fueled by the strong demand that we see globally, factoring into that overall growth. And then much made in terms of the birth replacement rate. What are we doing as a population in terms of growth? And this was a really interesting analysis that our supply team put together, which is supply increase and then global populations where the population is greater than 15 years old. And you can see two completely random data sets shouldn't have a heavy correlation, but you can see by and large, with the exception of 2020, they do. Albeit when 2020 plunged, broke the y-axis, and then brought it back up to the top. But if we look at occupancies across the globe, we can see that they are being kept in check. There's no standout performance, except when you can see the shift in holidays earlier in the year, where you'll make account for that large year-over-year comp. We're talking about 1 to 2% occupancy growth across all regions. And that's because supply is not going away, even with interest rates being in a different environment. Touched on it on some of the panels before. We know that the financing environment has changed. We're not seeing as many new developments. Brands are focused on conversions for a number of reasons, and conversions, as we know, don't have the impact on net supply. But even while we're seeing more challenges, we're not seeing the number of new projects or number of new rooms be that much less. You can see luxury, it's slightly more, but for all other classes, it's still around the same overall. And an interesting case study here in the UK, again, we're looking at demand. We're selling more rooms every month than we did relative to 2019. We do have the pride of place in terms of occupancy for the G20 countries. We've got the highest achieved occupancy overall. But we also have pride of place in terms of active pipeline and in construction. You combine all of those facts together, and you're going to get continued occupancy growth, but it is going to be muted, 1 to 2%. And in some cases, actually, you talk about a Belfast, Manchester, and others, it's going to be slightly negative. So even while we've got record demand, increasing population helping to fuel some of that demand, but also developers looking to couple that with supply growth across the market overall. And this is another interesting analysis from our parent company, CoStar. Just thoughts around this out. This is a UK slide. So hotel transactions last year as a percentage of office, you can see absolutely leap well above the average that you can see in the orange dotted line. Interestingly, speaking to many of you even just now outside while having lunch, the number of office conversions coming to the fore, and also just the attractiveness of hotels as an asset class, and also a bit of uncertainty for office, especially outside of that prime, really 5-star location for city center office. And then a lighter events calendar for us in 2025. We can't host the Olympics again. We can't have the European Football Championships again, even though I would love it because maybe England would finally win if we could host it every year. I still have faith we'll see it in my lifetime, but who knows what we'll see. Olympics, though, we know great success in terms of actuals achieved. What did that translate to in terms of percentage growth for RevPAR? 162% revenue per available room growth, largely fueled, almost exclusively fueled by average daily rate. Interesting note on the Olympics, and we saw this for all of the destinations going all the way back to Beijing in 2008, Rio as well, as there is displacement both before and after the Olympics. Two reasons being high prices, crowds, some people looking to avoid those crowds, as well as high prices. And then Paris was unique as well, where the Parisian authorities were saying, please stay away in the lead up to the game. So you can see the impact that had on the market overall. And if we remove that leap, so what you can see, the gap or the break in this heart monitor data set, if you will, is the Olympics themselves. You can see both the displacement before and after. And I thought this was a really fascinating analysis where we know that there's going to be an ADR hangover for all of those Olympic destinations, but there is also an occupancy hangover, though I would say, as a positive note for Paris, a much more similar comparator would be London, more mature market. Actually, I think occupancy will be a tailwind for Paris this year, and if there's any kind of decline, it would be very minimal like we saw in London in 2012. Also keeping in mind as well, Paris as a market has less rooms than we see in London and had less rooms at the time of the game overall. European Football Championships, much more notable for your Leipzig, for your Dortmunds, for your markets that don't have that inherent level of demand. So your smaller markets will feel that more acutely. And if you look to the likes of a Munich there with the Weltmesse, just the huge long line of events that we'll continue to see. This is our forecast for 2025. Taylor Swift, she's going to get a second shout out as well, as Tom said, God bless her and her Eras Tour and her ability to generate GDP. Warsaw hoteliers, as you can see from this graph, will be begging that she comes back again, but who remains to be seen what will happen there. This always a great data set to call out. And STR, we're always known for our top line data, KPIs, occupancy, average daily rate, revenue per available room. We do also track profitability data and gross operating profit per available room. We align that all with USALI guidelines. And what you'll see interestingly here is we know that top line is up, but we also know that what's making its way to the bottom line. And you can see a decline of 8% there for the year, through to November, still processing the full year. And you can also see the amount of euros per room taken over during those main events. So the importance of those huge events and how they flow through to the bottom line. And why is that important? Total labor, as we know, making up anywhere from 50%, say, of overall expenses. F&B about 40% of all labor costs. What you can see here is that labor costs looking like it's going down slightly. That's because while it increased 10%, our sample for this P&L, granted a different sample, actually saw occupancy outpace that. So even though labor cost is growing, occupancy for this data set was able to outpace it. And I think really interesting to see as we face more challenges in terms of top line. We already know that bottom line is a reality that hoteliers will have to contend with, and some of the challenges that may be evident in the year ahead. But it's not all doom and gloom. There is positive trajectory to be seen overall. We can see more business on the books there. So this slightly more data than the prior slide looking at the Mediterranean, but for December, Q1, a positive trajectory overall. Luxury and upper upscale being the ones that are leading that in terms of the number of business on the books, about 2% ahead there. Looking at our forecast, we know that the third quarter is going to make for a tough comparator. There's absolutely no way for us to sidestep that. But overall, you can still see some commendable growth as we get towards the latter stages of the year. ADR still having a bit to play in that. A nice note to end on here, there's so much noise, and I think what the gentleman from Pandoc said on stage was lovely, to go to sleep and sleep deeply because you don't know what the alarm clock will bring in the morning, and to try and block out some of that noise. And we can also learn a tremendous amount by looking to the past. So this is week over week occupancy in Europe, what we saw in 2018. What did we do in 2024? There's no AI, no machine learning applied to this data. It's simply overlaying the two data sets. And when the calendars and holidays align, you can see how much we tend to repeat ourselves. And what have we done to start the year in terms of 2025 there? you can see we're actually starting to track overall similar. So we can learn a huge amount for the past. But thank you so much for spending your post-lunch time with me. Really appreciate it. All the slides we'll make sure can share with you as well and a refresher on some of our themes. But thank you so much and have a great rest of your day. Thank you.